In the world of global finance, a shockwave hit, sending ripples through every major market and boardroom across the globe. The tremor began when China, the world's second-largest economy, sold $8.2 billion in U.S. Treasury bonds, an amount that, while not catastrophic on its own, carried enormous symbolic weight. This wasn't just a routine transaction, it was a calculated signal from Beijing to Washington, a bold move that challenged the stability of the US dollar as the world's reserve currency and questioned the very foundation of the global financial order. For decades, China recycled its dollar earnings into US government debt, creating a financial symbiosis that underpinned global stability and allowed both nations to prosper, even as their rivalry simmered beneath the surface. But this sale marked a shift. U.S. bonds, once seen as the ultimate safe haven, became a tool of geopolitical leverage, a bargaining chip in a high-stakes game between superpowers. The timing was no accident, coming after months of escalating trade tensions, new U.S. trade restrictions, and a series of diplomatic standoffs that left both sides searching for new ways to assert their power. Instead of retaliating with tariffs or sanctions, China struck at the heart of American financial strength, targeting the very asset that underpins the global economy. The message was clear. China has powerful financial weapons of its own, and it's willing to use them if provoked. This was a warning shot, not just to the US, but to the entire world. The world watched in real time as the foundation of global finance suddenly looked fragile, with investors and policymakers scrambling to assess the risks and potential fallout. This wasn't just a line on a balance sheet, it was a turning point, forcing tough questions about the future of the global economy, the reliability of old alliances, and the durability of the dollar's reign. How secure is the dollar's dominance when its biggest foreign creditor signals doubt? What happens if others follow China's lead? The sale reminded everyone that global finance is built on trust, now in short supply, as suspicion and uncertainty take hold. The aftershocks of this move will echo for years, reshaping strategies, alliances, and the very architecture of international finance. The era of financial certainty is over. The rules are being rewritten in real time, and no one knows exactly what the new playbook will look like. The world is bracing for what comes next, as the balance of power in global finance shifts before our eyes. To truly grasp the significance of China's recent actions, it's essential to first understand what U.S. Treasury bonds are and why they matter so much in the world of finance. U.S. Treasury bonds are essentially IOUs issued by the U.S. government. When you buy a Treasury bond, you're lending money to the government, which promises to pay you back with interest over a set period. These bonds are considered the world's safest investment, not just because of America's economic size, but because they're backed by the full faith and credit of the U.S. government, meaning the government can always raise taxes or print more money to repay its debts. That's why U.S. Treasuries form the backbone of the global financial system. Investors, banks, and even entire countries trust them as a safe place to store wealth, especially in uncertain times. Countries like China buy massive amounts of treasuries to safely park their dollar reserves and earn steady interest, making them a crucial part of their financial strategy. For China, holding U.S. debt was a logical way to manage its enormous trade surplus with America. Every year, China exports far more to the U.S. than it imports, accumulating billions in U.S. dollars. By buying treasuries, China not only puts those dollars to work, but also helps keep its own currency, the yuan, from rising too much, making Chinese exports more competitive and supporting its export-driven economy. At its peak, China held over $1.3 trillion in U.S. debt. This wasn't an act of charity or goodwill, but a direct result of China's economic model and its need to manage vast reserves. This created a unique mutual dependence. America relied on China to finance its budget deficits, while China's financial stability became tied to the health and stability of the U.S. dollar and economy. Any sudden move to devalue or dump U.S. bonds would send shockwaves through both economies, causing losses for China and financial turmoil for the U.S. That's why, until now, the so-called financial nuclear option, selling off U.S. treasuries en masse, remained untouched, seen as too risky for both sides. But as political and economic tensions rise, the old logic of mutual self-harm is starting to break down. The risk of damaging both economies is no longer enough to guarantee restraint. The paradox is clear. Weaponizing finance means both sides get burned, and the fallout can be unpredictable. China's recent sale of U.S. treasuries is a warning shot, not a full-scale attack. but it signals that the old rules of financial engagement may no longer apply in this new era of rivalry. The world's financial safety net, once thought unbreakable, is now showing signs of strain and fraying at the edges. Trust, always the invisible glue holding global finance together, is now at risk, and that's even more dangerous than the loss of money itself. The consequences of this unraveling could be global, affecting economies, markets, and people everywhere. For the past 30 years, the United States and China have built a remarkably complex and deeply intertwined economic partnership, one that has shaped not only their own destinies but also the trajectory of the global economy. American companies shifted much of their manufacturing to China, taking advantage of lower labor costs and efficient supply chains. This move fueled a massive boom in affordable goods for U.S. consumers, making everything from electronics to clothing cheaper, while simultaneously driving rapid industrial growth and urbanization in China. This unique chimerical relationship became a powerful engine for the world economy. U.S. consumer demand drove Chinese factories, and in return, China's vast savings helped finance America's growing deficits, creating a cycle of mutual dependence. As China's dollar reserves soared, the most logical and secure place to invest them was in U.S. Treasury bonds, further tightening the financial links between the two nations. This cycle of investment kept U.S. interest rates low, making borrowing cheaper for American businesses and households, and fueling further economic expansion. Yet, beneath the surface, the relationship was never truly balanced. America saw millions of manufacturing jobs disappear, hollowing out entire communities, while China sought to climb the value chain, investing in technology and innovation to reduce its reliance on the dollar and low-end manufacturing. Over time, mutual suspicion and distrust grew. The benefits of partnership began to fade, replaced by a new era of strategic competition and rivalry, as both sides questioned the sustainability of their codependence. The seeds of today's economic and geopolitical conflict were sown during this era of deep codependence, as both countries realized the risks of being so closely tied together. Now the very financial ties that once bound the two giants together are being weaponized, used as leverage in a growing contest of power, with sanctions, tariffs, and currency moves becoming tools of confrontation. The era of easy cooperation and mutual benefit is over, replaced by uncertainty and competition on the world stage. The world is now entering a new and unpredictable phase of US-China rivalry, with consequences that will ripple across every continent. In April 2025, the US-China economic truce shattered. The US imposed sweeping tariffs and strict tech export controls, aiming to cripple China's high-tech ambitions. Beijing saw this as an existential threat, not just another trade spat. Instead of immediate retaliation, China hinted at using its US bond holdings as leverage. The idea of weaponizing treasuries moved from theory to reality. In July, China's $8.2 billion bond sale was a calculated response, big enough to send a message but not enough to trigger a meltdown. The battleground shifted from trade to finance. China showed it was willing to take some pain to pressure the US. The conflict had entered a new, more dangerous phase. Financial statecraft replaced tariffs as the weapon of choice. The stakes had never been higher. News of China's bond sale sent shockwaves through global markets. US Treasury prices fell, yields spiked, and borrowing costs for the US government jumped. Higher yields rippled through the economy, raising interest rates on everything from mortgages to corporate loans. Stock markets tumbled as investors fled to safer assets. The dollar weakened against major currencies, shaking confidence in its long-term security. Gold and oil prices surged as investors sought safe havens. Central banks worldwide scrambled to assess the risk of contagion. The sale exposed the fragility of the global financial system. Even a relatively small move by China had outsized effects. The message, the balance of power and trust in global finance, is more delicate than anyone thought. Markets were reminded that stability is not guaranteed. The world's economic foundation had been rattled. The fear was real and justified. The aftershocks would not fade quickly. The era of financial complacency was over. Everyone was on alert. Official responses were swift and evasive. The US Treasury downplayed the sale, calling it routine and insisting the market could absorb it. Behind closed doors, officials knew it was a political shot from Beijing. China, for its part, claimed the move was just prudent financial management, not a weapon. Both sides stuck to their scripts, projecting calm while privately recalculating their strategies. The real message: both governments understood the stakes, even if they wouldn't say so publicly. The world saw through the denials. This was financial brinkmanship, plain and simple. The fallout wasn't limited to Wall Street. Higher Treasury yields meant higher interest rates for everyone, on mortgages, car loans, and credit cards. For families, that meant bigger monthly payments and tougher choices. A weaker dollar made imports more expensive, raising prices on everything from electronics to gasoline. Businesses faced higher costs, squeezing profits and threatening jobs. Economic uncertainty spread, making people and companies hesitant to spend or invest. The psychological impact was real. Fear itself became a drag on growth. The financial chess match between superpowers hit home for millions. China's move signaled a global shift. Countries are rethinking their reliance on the US dollar, wary of America's willingness to use its financial power as a weapon. Central banks are diversifying reserves, adding euros, yen, and yuan. New payment systems like China's CIPS are emerging to bypass US-controlled networks. Gold is back in favor as a neutral, sanction-proof asset. The goal isn't to dethrone the dollar overnight, but to build a more multipolar financial world. The risk: if China accelerates its bond sales, it could trigger a global crisis, hurting everyone, including itself. So far, mutual vulnerability has kept escalation in check. But as competition intensifies, the temptation to use financial weapons grows. The old order is fading, a fragmented, unpredictable era is dawning. We're at a crossroads in economic history. China's bond sale is a symptom of deeper shifts in global power. The financial ties that once bound the US and China are now tools of rivalry. The immediate market turmoil is just the beginning. For ordinary people, the impact is real: higher costs, more uncertainty, and a sense that the old rules no longer apply. Central banks are preparing for a world where the dollar's dominance is no longer assured. The post-war financial order is fracturing. Will we see competing economic blocks and instability, or a new, more balanced system? The answer will shape the next era of global prosperity, or crisis. The world is watching, and the stakes couldn't be higher.